Hi, I'm Steven Van Metre. Welcome to your weekly economic update, where we take about 30 minutes every Friday to take a deeper dive into the economic data to see if we can make sense of some markets that are about to rip the face off of equity investors. I know, Steve, you're being dramatic. Look, I'm about to be right in a huge, gigantic way. And he's like, yeah, well, we've heard that before. Look, I know. A broken clock is always right twice a day. And we're finally getting to that point, because the market is not in a happy place. The plumbing of the market is backed up in a big way. It's not happy about it. I'm going to prove it to you, but look, I just want to get the disclosure out of the way quick. The content of this video is provided as educational information only and not intended to provide investment or other advice. Material is not to be construed as a recommendation or solicitation by or selling a security, financial instrument, or participate in any particular trading strategy. This video was prepared by Steven Van Metre, own personal capacity. Opinions expressed in the video that I do not reflect the view of Atlas Financial Advisors Inc. or Steven Van Metre Financial. Now, I need to get that out of the way because it is going to sound like I'm giving you investment advice today, but I'm not. So if you construe it as such, I apologize, but you should not take it as such. All right, so yes, equity investors are about to get their faces ripped off because they're mispositioned in the market again for the third time in 20 years. You know, we have this market set up. You got to think of how the market is, what it's telling people. Buy stocks, buy oil, dump your bonds because, hey, you don't need to protect yourself. The market's not going down anytime soon, so do not buy any form of insurance. In fact, if you're going to buy bonds, make sure you buy those high-risk junk bonds that pay a big dividend yield, because you do not need U.S. Treasury bonds. You do not need to hedge your downside because inflation is going to skyrocket. You don't need any protection. That's what the market's been telling people. That's what financial advisors have been telling people. That's how money managers are managing their client accounts. That's how hedge funds are managing their client accounts. That's what the financial media is telling you. Everybody's telling you the same thing. Take maximum risk because the party's just getting started. And it's not, because it's about to come to a screeching halt. And if you don't believe me, the stock market the financial media has been blatantly lying to you. And I'm going to prove it to you. Now, what has been transpired roughly in the past week? What is the big thing that you've heard? And think about what is the big thing, the big beating of the drum that's been going on by the financial media lately? The Fed needs to cut rates. So the stock market's a couple percent off its all-time high, and the Fed needs to cut rates. Do you know how many times that has happened in the past? Not very often. So why all of a sudden, if the market is doing so well, and we do know the Fed watches the market as much as they claim they don't really look at it that much, they do. How can you remotely justify a rate cut near the all-time highs? Why is so many people, I mean, we're talking investment professional, hedge fund managers, financial media, everybody's beating the same drum. Cut rates, 0.25%? No, cut 0.5%. The economy's in big trouble. And it doesn't make any sense at all. So what happened last week? Well, we had the producer price index come out. And we've had the consumer price index come out. And the producer price index was over the Fed's 2% target. Now, I do want to explain something here for those of you who've never heard this before. When the Fed says they have a 2% inflation target, they're not talking about what you and I pay for goods and services. They could care less. And it's really simple. There's a reason why. Let's say an auto manufacturer builds a car and takes it out to its dealership. The Fed can't control the fact that one dealership, say, selling the same car, might cut their prices a little lower to sell more. So they don't get a strong pulse on where consumer prices are. But a manufacturer cannot change the price of, say, steel. They can't do that. It's not going to work. So the Fed really cares about producer prices, or what they call something called core PCE, which I imagine is going to come out Monday, or I haven't looked. But generally, we get that data right as the Fed is meeting when they do have their meeting. Because the Fed knows that, look, we understand that for various fluctuations in the economy, inventory levels, and all that jazz, consumer prices can change quickly, but producer prices generally don't. The producer prices came in over 2%. And the market's like, oh boy, look, they're only like 2.2 or 3 or something like that. That's down a little bit. So what? It's still over the Fed's target. Doesn't matter. Then consumer price came out. Consumer price index came out at, I think, 1.8% annualized. Oh, in the market, oh, look, see, we're under 2. Cut. Look, the Fed could care less. Look, there's going to be fluctuations in the economy. It's just how it works. But the market, oh man, the Fed, and then article after article, the Fed has to cut because consumer prices fell below their target. And they've been below the Fed's target for most of this expansion. So why now? See, you got to think, why now? Because do you understand you're being lied to? I'm not there yet, but we're getting there. Then today, markets, okay. Yesterday, the retail sales are going to come in way under target, and the Fed's going to be forced to cut. It's going to be horrible, and everybody's going to be unhappy when retail sales slump. Whoopsie, retail sales surprise to the upside. Why? Because retail sales are tied to the stock market. When the stock market's up, people spend more. It's called the wealth effect. This is not new. This has been going on for decades. When the stock market is up, people spend more. They feel rich. They go out to eat. They buy cars. They do all kinds of stuff. They spend more money. Well, what happened in the first roughly week of May? Stock market hit all-time highs. And then, of course, it came down, but it hit all-time highs. And what did consumers do? They spent. Now, remember, I have said that these corporate share buybacks are a monster problem, because they always drag the market up when it should be coming down. And now they're going to keep the Fed from easing when the Fed actually does need to ease. I mean, look, I'm not a big fan of the Fed monkeying with monetary policy, but the financial conditions are indeed tightening. So what happened today in the market is all of a sudden investors are like, oh no, the retail sales look good. That's bad. We don't want that. We need a Fed to ease. And then what happened a little bit later? The Atlanta Fed, who is obviously a member of the Federal Open Market Committee that sets policy rates, okay, there's someone from the Atlanta Fed in that meeting. What happened? They revised their GDP estimates from like just under 1.5% to over 2%. Now, how are you going to get a rate cut if second quarter GDP estimates are revised up? You're not. But all of a sudden, the market is still like, rate cut. We need a rate cut. And so they changed their tune again. They said, look, if the Fed sounds dovish a little bit, stock market's going to go to, the S&P 500 is going to go to 3,000. And Steve, once it gets to 3,000, it's going to 3,200, and you better get in. And you hear this, right? And think of the psychology of this. The market's going to go up, and you hear it everywhere you turn. Market's going up. And what does that tell you? Reach into your pocket, pull out your money, and buy stocks. Why do they want you to buy stocks so bad? It's simple. Liquidity is dead. Liquidity in the markets is drying up. And corporate share buybacks cannot buy 100% of their stocks every day. There is a limit to how much exposure they can buy every day. There is a certain percentage of their average trading volume is all they can do. And I've said the last couple of days, look at trading volumes, they're collapsing again. The reason the market wants you to buy is they're desperate for liquidity. They need new money to come in, and it's not coming. So remember, what is the market telling you? Buy stocks, buy oil, sell your bonds, and short volatility. Now, as a retail investor, you should never, ever short volatility. However, by buying stocks and dumping your bonds, you're shorting volatility indirectly. What I've been showing you is the NASDAQ summation index is in a dangerous spot, and it tells us liquidity is drying up. And then there was an article today, and I will show it to you. I'm not going to show you the article because it's really confusing to get into derivatives, and we're talking stuff that's pretty deep technically. I'll just be honest with you. A lot of it is beyond my... I understand the big picture, but I do not understand the technicals of derivatives. But all I can tell you is, where is everybody positioned in the market? Stocks, oil, short volatility, and Irish bonds. And now they need more people to come in and buy, because the market is a continuous auction, right? It's constant buy, sell, buy, sell, buy, sell. But what happens is there's no buyers. Whoop, prices go down. And then what happens? You start to get an unwind, because when volatility goes up, all these you have $3 to $4 trillion in volatility control products. I've told you about this. You know it exists. You have these computerized trading programs that start trading down. You have the CTA models that look at price level points and starts to sell. The market is out of liquidity. And I want you to, the reason I'm going on and on about this, and gosh, I hope I have enough time to get to all the things I want to talk about, is I want you to understand as we talk about this, how smart the smart money is. They're darn brilliant. Because what is the smart money doing? They're not buying stocks, they're selling them. They're buying volatility. Again, as a retail investor, I do not ever recommend that you do that. It is extremely risky. You should never, ever, ever buy it if you haven't gotten that impression yet. They're short oil. They're buying U.S. Treasury bonds. Because what's happened, here's how smart the smart money is. When Treasury yields and stocks decouple, so we have stocks up here, Treasury yields down here, there's one of two things that have to happen in our monetary system. See, the average financial advisor, I'm going to go on the limb and say 99.9% of financial advisors do not even have a clue of how the monetary system works. They don't, and I'll go even further to say they don't even have a clue what the stock-bond relationship is. They don't know why interest rates go up in stock. They don't know. They don't, and they probably don't care. The smart money understands exactly how the monetary system works because probably their ancestors invented it. So when you have this massive decoupling, stocks up here, Treasury yields down here, Treasury yields headed lower, there's one of two things that has to happen. Now, you'll hear this phrase called the alligator jaws have to close. I probably said it some long time ago. The alligator jaws have to close. So you've got stocks up here. So either stock prices have to come down to where Treasury yields are, or Treasury yields have to go up. And when you understand how monetary decelerations work, you know Treasury yields cannot go up under our monetary system. And when you look at the large commercial banks, as we do every week, they're buying bonds. So how can interest rates go up when you have large commercial banks buying like $100 billion worth of bonds in the last 12 months? And then they said, oh, don't worry. The financial community said, foreign investors aren't buying bonds. We look at that every week, right? Every week I try to post the major treasury auction data. They're bought. They've been buying. I don't know. Yeah, sure. They're selling some of it. They're probably selling their short-term bonds to buy long-term U.S. Treasury because guess what? Foreign central banks, they're smart. They're smart money. They know. So the jaws have to close. And here's the brilliance of the smart money. They knew, and they understand investor psychology, so they knew that corporate share buybacks are going to put stock prices way up here. And everyone's going to get excited because what do American investors do? They buy stocks when they are high. You never see them buy stocks when they're low. Always buying high because they're high and going higher. Very dangerous. Meanwhile, the smart money was quietly buying bonds and driving treasury yields lower and lower and lower and lower and lower. And what happened? Hedge fund managers and everyone else short bonds, interest rates. See, everyone said, no, interest rates have to go up to stock price. Short, 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 short. And they get on the news. Jeffrey Gundlach, the bond guru, one of two bond gurus, said if it wasn't for the Fed, he said this week, if it wasn't for the Fed, 10-year treasury yields would be 6%. Look, either the guy is a blatant liar, and he's lying to you, either that, and I don't, that's probably the truth, or he doesn't understand the monetary system, I don't buy that. Or he was making money on people shorting bonds, and he just got his face ripped off on his hedge fund. Now, we won't see that because that data is not reported, so we don't know. So he was wrong. This is one guy. This is one of two people that are considered the foremost expert in bonds. He was wrong, but it doesn't matter because he got people to it. So this gap has to close. So what happens if you're buying volatility? If you're the smart money and you bought volatility, right? How do you make money? Now you don't make money when stock prices go like up and down a little bit. You make money when they go down, big chunks of movements down. Now, how do you get that to happen? Well, one, you got corporations buying stock backs and every investor in the country thinking that this is the best time to put all their 100% of their money in stocks. even though they did not learn their lesson during the past 2 recessions. Number 2, you quietly drag interest rates down, quietly, slowly, and you say nothing about it. Now, I have said that bonds are in a bull market and stocks aren't. Have you heard that in the news? Nope. No. What do you hear? Buy stocks. You don't hear this. So if these jaws have to close, the bigger the gap, the bigger the drop. And so the reason you're hearing investors crying to the Fed to lower interest rates is because they need liquidity, because it's drying up. And the smart money's positioned for that. Because guess what happens when liquidity dries up? Volatility rises and interest rates fall. And guess where everyone's at? Oh yeah, and oil prices fall too. Because oil prices follow the economy. So how's everyone positioned? Well, if volatility goes up, stock prices go down a lot. Smart money, win. Interest rates go down. Bond prices go up. Smart money buys bonds, makes money. Everyone else is short bonds somehow, some way. Lose money, right? Oil prices go down. They're already falling. What do you think is going to happen when here's another example. We had 2 oil tankers get torpedoed or however they got damaged. I don't know if there was oil loss or not, but what happened? The market's like, oh, oil prices are going to go up because 2 tankers got hit. Look, do you really think that two tankers are going to disrupt global oil supply? No. Okay, so maybe some tankers aren't going to be moving as quickly as they did, and I know insurance rates on tankers, they're passing their air, just jumped. Do you really think that that's going to disrupt global oil supply? No, because the United States is near its 2-year high in oil as it is. And we are the biggest producer of oil in the world. We are right now. We're producing crazy amounts of oil. So the smart money is short oil. And they know when stock prices collapse and inventories keep building, so we're going to predict that inventory is going to build next week, and I'll stick to that. It probably will. That oil is going to come down too. And so the smart money's got this thing lined up perfectly, and they did it all because everybody thinks stock prices are going higher. And what is the financial media telling you? I'll show you. Because they didn't quit. They did not give up. Now, this is a couple graphs from, look, I'm going to do my best to explain it to you. Hopefully you'll follow it. This is a cross-asset volatility. The MOVE index is the bond volatility index. So when bond volatility index rises, so do bond prices. So this means interest rates are going down, bond prices are rising. Congratulations to anybody who owns U.S. Treasury bonds. The VIX index is the equity volatility index tied to the S&P 500. You will notice that when the black MOVE index goes up, and when this other one, the OIV, which is commodity index, goes up, eventually stock volatility rises. See them? How they move together? And stock prices come down. This is apparently a graph showing that the short-term volatility is rising, and this is going to pull volatility up. It's going to cause a major problem. But this came out today from Bank of America Merrill Lynch that said if the Fed is dovish and there's a G20 deal, first of all, there's going to be no G20 deal, all right? They're saying S&P is greater than 3,000, so you should better buy. See, again, Bank of America. We are holding bad positions here. We need you to put money in. Look at this. This is great. What if the Fed's hawkish, wants to raise rates? Not going to happen. And there's a G20 deal. There won't be. Oh, the S&P is still going to go up. But you better buy. Oh, and here's some things that are not going to happen. There's no way the Fed's going to be hawkish. There's no way there's going to be a deal. But look at this. Look at the position in the chart. Why didn't they flip it? Because people stop here, right? Oh, look, S&P over 3,000, S&P at 3,000. Yeah, okay, whatever. Long bonds, are you insane? No way. So that was today. Do you get you're being lied to? Because these people don't care about your money. They never did. Did they warn you in the last 2 recessions? No. But the plumbing in the market is backed up big time. And the market's running out of liquidity. And corporate share buybacks, as I've said, can't keep it up. Oh, here's the best part. What's going to happen late? So we got the Fed meeting next week, right? Then we have the corporate share back blackout starting. Oh yeah, but do we talk about that? Isn't the timing of this brilliant? And then there's a G20 meeting, which as I've discussed before, if you threaten a leader in China, this is not how it works, they will die. They will fall on their sword to save face. They will not publicly embarrass themselves in front of their citizens. So the odds of President Xi meeting with President Trump are pretty darn close to zero right now. In fact, they're so close to zero, we have actually extended an invitation to meet, apparently, and they have not even responded. And that's coming at the end of June. Kudos to smart money, because they've got this thing set up, lined up. They got the pins right down the alley, and that ball is flying right into the strike zone. All right. You know what? This may go longer than 30 minutes, but I think it's totally worth it. I think it is totally worth it. And the money supply grew to 4.32%. I'm still struggling to figure out what's driving this, but it doesn't matter. There is a lagged effect in the economy. What I do think is going to happen is when the market comes down, there will be a bounce because the money supply is rebounding. The 6-month rate of change is at 2.5%. Meaning it's reflecting that the growth rate is going to rise up to 5%. The 3-month rate of change is at 6% annualized. So that's showing that there's some demand here in the money supply. But again, I don't know exactly where that's coming from. Looking at commercial industrial lending, the 3-month rate of change nearly crossed zero last week. It bounced up a little bit, but the growth trend rate on the annualized rate is still headed lower. So commercial banks are not borrowing nearly as much money. And consumers aren't borrowing as much anyway either. They're using their credit cards. They're holding roughly flattish at 4.4% annualized. Again, not enough really to drive the economy, but somehow the money supply is growing. The Federal Reserve balance sheet increased $2 billion. Oh, and guess what? They're still unwinding. I mean, this still has not really impacted the economy in a major way. That's to come. And consumers are totally unprepared because bank deposit growth rate fell to 1.4%. Last week and still super weak. So nobody is prepared for this unless you own treasury bonds in your portfolio. And here's a brilliant comparison. We've kind of, Nautilus Capital Investment Research has been updating this, and you can see the 2007 analog. It gets over this peak just where we're at now, and then a face-ripping rally down, followed by a rebound, except I think this is going to be much deeper only because we have all these volatility control products that we did not have back in 2007. And here's the equity volatility versus yield curve. We looked at this before. It's saying volatility should be rising. But investors are telling their clients, and money managers are short volatility. Big major pension funds, short volatility. Everybody is wrongly positioned in this market. And the New York Fed's yield curve-based recession probability model says we're at a 36% chance of recession. And every time their models moved over 30%, a recession has happened. So we are in recession territory according to the New York Fed. Isn't that crazy? Oh, I guess this may be an updated version. Is that the same chart? Yep, this is an updated version. I should have caught that. Here's an updated version. Here we are. Here, look at that. Very, very similar setup. Next move ought to be down. The next couple of charts were posted on Twitter by Northman Trader. You can find Sven Henrik at northmantrader.com. And so he's saying, look, at corporate profits are flat. And everyone's so bullish about stocks. They can't get enough. Stocks. But look at corporate profits. They haven't gone anywhere. Flat. And this is not an annualized rate of change. This is truly billions of dollars. Flat since 2012. And he says, look at this. When you compare debt, the blue line, debt's rising and been rising, profits are flat. And then he quantified the numbers, which I think is brilliant. So going back to 2012, he says, look, corporate profits were $2.2 trillion. I'm guessing that's $2.2 trillion. And liabilities, so corporate liabilities, were at $4.2 trillion. No big deal, all right? So that's okay. So here you are. Fast forward to 2019, 7 years later. Do you notice much of a difference? No, it's less. So corporate profits have dropped, but we'll just say they're flat. But look at corporate debt, $6.4 trillion. See, people are buying stocks in companies that are massively over indebted, and they think it's the best time to buy stocks in their life. Are you kidding me? Wait till all this debt wait till investors figure out all this debt. These corporations will once again do what they've always done. They buy stock at the peaks so their executives can cash out, and they will sell stock at the bottom to pay for all their debt. Cycles it's all the same. It's all the same. Now, this is Northman Trader's target. Remember, I talked about how I thought the S&P 500 was going to hit, say 2,100 or lower. This actually comes from his wife as a private Twitter feed for paying customers, which I'm not, but he posted it on his public feed. So you can go to, again, Northman Trader on Twitter, and you can see all of his charts. He's really interesting follow if you use Twitter. But he's saying, look, this thing's headed way back down. No surprise, the smart money's buying volatility. They need a big plunge down. And believe me, this 2350 to get down to 2100 it's not a big gap to break through these December lows. And here's what's going to keep the Fed on the sidelines. There's probably likely no cut. Is the GDP Now model went from, let's see, it doesn't say, but it's at 2.1%. And look at how here it jumped up from 1.5, 1.4, boom, on today's retail sales data. That, folks, is why corporate share buybacks always fool investors. They did it in 2000, and they did it in 2007, and they're doing it again, and everybody bought into the same story, just like they always do. Now, let's talk about climate conditions. The USDA, I found some new people, excellent sources, that say, look, the USDA generally is going to misreport crop progress because they are hopeful that it's going to improve and they don't want to scare people. Now, look, you're getting a cold front rolling through. Unfortunately, not so much for us, although I'm sure we would be happy to have it. And hybrid crops need a lot of sun. They don't need cool air. And look at how the rain has increased. The rain is getting even worse than it was when we looked at it last week. The storms are getting worse. And now, this is a 6 to 10 days, so next week, 2 weeks out, hey, we get some cooler weather. That would be nice. And, wow, it's going to be massively blistering hot in the southeast. But look at all this rain. It's going to stay even still bad going into the next 2 weeks. And all of this rain, so you got east of the Rockies, west of roughly the Appalachians. This is a watershed zone where water in this area flows all the way into the Mississippi and down into the Gulf of Mexico. And that's going to keep flooding a long way, just going to keep flooding. Bad news. Here's the NASDAQ summation index that we now look at every time we have a video, because it's saying, look, this needed to rise here. It's stuck around this minus 300 range, needed to rise. It's saying liquidity is a massive problem here. And if this doesn't jump, and it doesn't appear to be it's going to, and it keeps falling, it's going to yank liquidity out of the market, cause a massive unwind that nobody is prepared for. And if we take a look at sunspots, I think this image is cool, and I don't know why it switches to that when I go there. But again, I've been looking at this almost every day this week. Still no sunspots, so that means the weather patterns are not going to improve. But here is the chart of charts, as if any of those were bad. They're all, very favorable for what we're looking at. Look at the big increase in U.S. Treasury bond. Remember, the banks lured people in. They just stopped buying. Look, remember, it was like, flat. Bam, $14 billion worth of treasuries. They're going for blood. This is the smart money, folks. They know what they're doing. Bam, $14 billion worth of treasuries. Follow that up by what? $15 billion worth of mortgage-backed securities. Boom. And they shed $1 billion of non-mortgage-backed securities. So there you're at almost $30 billion in net purchases last week of bonds. Tell me that no one's interested in bonds? The smart money is, and you should be too. If your portfolio is not hedged, you're going to wish it was. And there's going to be a lot of money managers that are going to find out really, really badly what it's like to manage unhedged portfolios when we see another plunge down. So markets sitting above 250-day moving average. Look, the smart money brought this thing right back where they wanted to. They got it over all the major moving averages. Probably over the weekly moving averages. Yep, over the weeklies, over support. And what did we hear all week? Market's going to go to new all-time highs. Why? I don't know, because it's not going down, so it has to go up. And so that's all we heard about. But all the other data says, no, that picture is not correct. In fact, if we look at volatility on the VIX, we see that it's in this coiling pattern. And you'll notice the 50-day moving average is about to cross upwards of the 100-day moving average. Check this out. Every time the 50-day start in green starts crossing, intersecting with the 100 in blue, volatility spikes. You see it there, and you see it there, and you see this beautiful setup right here happening in the vol space because the smart money's been buying volatility for a while now. Brilliant, brilliant, brilliant. Take a look at 10-year Treasury. In fact, let's look at all Treasury yields. Let's go look at 13-week. If we're going over 30 minutes, I hope you don't mind, because as far as I'm concerned, this is going to be one of my best updates ever. Just strictly opinion-based at this point. But anyways, here we have 13-week Treasury bills. Keep this in mind, 2.125. So 13-week Treasury yields are falling. 5-year Treasury yields are sitting right on support. Actually, they bounced off support today, so you can see they bounced up. But look what happens when 5-year Treasury yields break down. They got a long ways to go. I mean, they got look, you can see the last time they broke support, boom, 5-year Treasury yields went under 1%. That the same line? Yeah, there it is. Boom. So that's telling us the 5-year Treasury yields are headed way, way down. And remember, when you have everybody in short Treasury positions, they're forced to hedge by buying bonds. The smart money is probably going to drive interest rates to new all-time lows. It wouldn't shock me. Look at 10-year Treasury yields sitting right on the cusp here. In fact, if we zoom in, they came, and this is smart. They came, smart money kind of just pushed it right back up. Just let this thing kind of percolate, maybe through to the Fed meeting on Wednesday. Get people optimistic to come in and short. Maybe push this up one last hurdle. But look what happens here. When this thing breaks down, you're talking 1.7%, maybe, and that's probably going to go lower because that's the initial move. We're not talking about when all these computerized models start buying bonds. I mean, you got $3 or $4 trillion in equity strategies that can shift to buy bonds on a daily basis, weekly basis, and monthly basis based on volatility rising. Take a look at 30-year yields. When they break here, boom, 2.2%. And people are going to be happy. People didn't want to buy bonds up here at 3.3 because Jeffrey Gundlach, the bond guru, told them we're going to 6. Yeah. They should revoke his bond guru title, in my opinion. But anyways, you want to know how many people are going to be buying 30-year treasuries at 2.2 and happy about it? A lot. Because their money managers are going to do it. All right, let's carry on. Oil, also going to drag liquidity. Look at oil, crude oil prices. These are not crude oil prices. This is oil and gas producing stocks. We'll look at crude oil prices momentarily. Look, you want to see another build next week? Do you know what that's going to do to prices? What's going to happen when builds come in the next couple weeks? We just had, you got to think about this in a big picture way. We just had a strong month. Last month was a strong month of retail sales. We had maybe 2 weeks of slight builds. We've had, week after week, draws, but we have week after week of builds against a strong month of retail sales. So you got a bunch of people that are short oil. What are they going to have to do? Long oil, they're going to have to go short to hedge their positions because they won't be able to get out of it. That's going to tell you that oil and gas producing stocks are probably going to break through here. Let's look at crude oil, same setup. Bounced off support. Boom. It's going to break through support here. And you can see when it does, it tends to get down to this $38 range. And remember, we look at that report. There's a lot of longs on the oil contracts. If they're starting to shift short, they could drive this thing all the way down into the 20s. Very, very easily. You want to be a buyer at oil at 20 or 52? I'd love to be a buyer down there in the 20s. And I know there's some people on here listening that are smiling right now because they know that's a very high probability choice could happen. Let's take a look at ag commodities sitting right under resistance here. I kind of wrote about this if you've read that first. Tag their 200-day moving average right on the nose for the most part. From this perspective, if there's not a lot of heavy selling in here, then boom, prices are going to go up to the next level. Look to see if there's sellers. And at some point, what will happen is these people that are short here and short here. So you get the idea that everybody's short the stuff that's going to go up. That's how markets rise, is when you flush short sellers out. And they're all mispositioned, because why would you be short ag commodities when you have record flooding, historic record flooding in the Midwest? I don't get it. But anyways, you flush these short sellers off, then you're up here, flush these out, and you've got this Maginot line here at 20, and sky is the limit for those. Let's take a look at 7 to 10 year treasury bonds. Again, sitting right here on the cusp of just a breakout, and you've got blue sky. I mean, there's a little bit of resistance at around 110 here, but there's all these people are short. Boom. Potential new all-time highs in bonds. Now you know why I'm considering reallocating the legacy portfolios to long bonds, because when these things go, boom, there's a lot of return here. And it's going to shock people. So looking at that, I wanted to see the commercial bank data today, because I wanted to see if they were buying bonds, or if they were holding, selling, buying, and bam, I'm at 30 billion plus in bonds. Bingo. So now we just need to see the Fed say, well, we can't hike. We can't ease because the economy looks good. That's what they're going to say. How can they not? How do you ease when retail sales came in above expectations? When GDP growth is being revised higher? You can't. You really can't. And if you're data dependent, they want to. Trust me. They're going to want to. They will buy probably the next beam when this face-ripping rally gets the market. All right. I know we're over, but we're just going to keep going with this. Look at lumber. Had this double bottom here. It's chasing up to its 200-day moving average, or 50-day moving average. May not even make it. And then if lumber reverses and heads lower, that's going to tell us that yes, and it should, because interest rates are telling us that the financial conditions are tight. We should see housing further slow down. Everything is telling us the economy is slowing down. Look at the dollar. What did I tell you was it last week? Is the dollar bullish or bearish based on, I don't even remember what we're talking about. And I said it doesn't matter, because it bounced off its 200-day moving average. And when you have when the 200-day moving average acts as support, let's see what happens. Prices go higher somewhere in here. There's got to be, all right. Well, this isn't the best chart to show it, but look, you see 200-day, 200-day, 200, 200. What's it going to do? It's going to at least get back up here and test this double top. And if it breaks through that, now you've got a chance of this thing getting up into up near 100. You want to watch exports crunch? You want to watch stock prices crunch? Financial conditions get real tight when the dollar rises. Let's carry on to the gold. We'll try to break out at 40 minutes here. Look, getting rejected. I said this thing is not. Look, gold has got one last reversal. Remember that Wyckoff pattern comes down, makes a move up. Now this down move should have come down here, but it didn't. Look, it doesn't have to follow it exactly. The next move should breach this high. So could gold get up here to roughly 1360? Oh wait, it did. There, see that little red bar? Very hard to see. Got there. So you got these hedge fund managers, buy gold, because they probably bought somewhere in here. That means gold gets retraced down to here. Strong buy there, because emerging markets are already confirming gold's headed lower. Because why? I just showed you the dollar is confirming its 200-day moving average. Why would you want to buy gold when the dollar's headed higher? The dollar's got to make its one last move before the Fed capitulates. It's got to. Look at the GDX, the large miners. There it is. It kind of is trying to nudge. It wouldn't surprise me if this thing got up into the $24 range. Then it would really make that Wyckoff pattern look really cool. But let's take a look at the junior miners, where I think the bigger opportunity is. I did a big write-up on this for fall, not this week, but next week, or maybe the week after. I may have to postpone it, but it's a good write-up. But here's a beautiful pattern. Double bottom. Give me a nice triple bottom, and boom, go. This thing is going to hit the moon. And just to kind of end this on a positive note, I hope you take the time to read today's update about the bond market, because and I do not have any other confirmation of this, but my hunch is what the Fed's going to do to bring short-term interest rates down, because this guy uses the name Wolf Street. He figured out that the Fed is dumping long-term bonds for short-term bonds. Now, we knew the Fed wanted to do this, and they said they weren't going to do this until October. Right. After they finish their tightening cycle, which they're still doing. But the beauty is when the Fed sells long-term bonds, so you got to have long-term assets to match, right? So what's a 30-year, who buys 30-year loans? Oh, people that buy houses. Well, what's happening in the housing market? Slowing down, right? You get it? So the Fed's putting money out that needs to find backers. That's why interest rates are going down. The Fed's got your back. Commercial lenders got your back. We just need to make sure the Fed's got there. And bam, you got it. I'm Steve Van Metre. Have a great weekend. The fireworks are about to begin.